So you finally completed purchasing that vacation property. Now what? Are you going to live in the property 12 months a year, rent it out 12 months a year, maybe live in it part-time? Today's video, we're going to discuss some of your options. Let's get into it. Do you have a second property that you use for personal vacations and renting out? The IRS wants to know how much time you spend doing both those things because the answer can affect your federal income taxes. So if your vacation home falls into the rental property category, here's a few ideas on some tax angles. So if it falls into the rental property category, your vacation home is classified as a rental if you rent it out for more than 14 days during the year and personal use during that year does not exceed the greater of 14 days or 10% of the days you rent the home out at fair market rates. Fair market rates. So personal use generally means used by the owners, certain family members, and any other party, family members or otherwise, who pay less than their fair market rental rates. So if your vacation home is used by another person under reciprocal arrangement, for example, I use your place, you use mine, such use is considered personal use. That's the case whether or not you charge the other person fair market rent for your property or whether or not you pay fair market rent for the other person's property. So count only actual days of rental and personal use, disregard days of vacancy, and disregard days spent mainly on the wonderful repairs and maintenance activities. So let's delve into an example. Let's say during 2021, you rent your lakeside property out to a third party at market rates. So for example, for 210 days, your family uses the place, let's say for 22 days, because your personal use does not exceed the greater of 14 days and or 10% of the rental days, the lakeside property is classified as a rental property for the year, and those tax rules apply that I discussed. So if it's a personal residence, your vacation home is classified as a personal residence. You rent it out for more than 14 days during the year, and personal use during that year exceeds the greater of 14 days or 10% of the days you rent the home out at fair market rates. So once again, count only the actual days of rental and personal occupancy. Disregard the days of vacancy and disregard days that you spent mainly on repairs, maintenance activities, what have you. So let's say during 2021, your family and other family members and friends use your lakeside house for, let's say, 92 days, and you rent the place out to a third party at market rates for 122 days. Because personal use exceeds the greater of 14 days and 10% of the rental days, the lakeside property is classified as personal residence for the year, and those tax rules apply that we discussed earlier. So fundamental tax rules for rental properties. For vacation homes that are classified as rental properties, mortgage interest, property taxes, other expenses must all be allocated between rental and personal use based on actual days of rental and personal occupancy. So the wonderful mortgage interest deduction, deduction to personal use of a vacation home that is classified as a rental property does not meet the definition of qualified residence interest for itemized deduction purposes. So the qualified residence interest deduction is only allowed for mortgage interest on a vacation home that is classified as personal residence. So another example, let's say impact of classification as rental property on mortgage interest deductions. So you rent your cabin out, let's say for 210 days and use it for personal purposes for only 21 days. So the place is classified as a rental property. That means you must allocate all the expenses between rental and personal uses using 210 and 231 as the rental use fraction and 21 and 231 as the personal use fraction. So 21,231 of the mortgage interest for the condo is non-deductible. The same is true for 21,231 of the expenses, insurance, utilities, maintenance, depreciation. However, you could potentially deduct the personal use portion of the real property taxes on Section A of your Form 1040, subject to the limitation on itemized deduction for state and local taxes. The Schedule E losses and the dreaded passive activity loss, PAL rules, these rules, I'll tell you, when rental expenses exceed rental income, a vacation home classified as a rental property can potentially generate deductible tax losses that you can report on Schedule E of your Form 1040. Great. So unfortunately, your vacation home rental loss may be wholly or only partially deferred under the dreaded passive activity loss, PAL rules. So here's why you can generally deduct passive losses only to the extent that you have passive income from other sources, such as your rental properties that produce positive taxable income. Disallow passive losses from properties that are carried forward to the future tax years and can be deducted when you have sufficient passive income or when you sell the loss producing property. So small landlord exception to PAL rules. I had this exception. A favorable exception to the PAL rules allow you to currently deduct up to $25,000 of annual passive rental estate losses if you actively participate and have adjusted gross income AGI under $100,000, and the $25,000 exception is phased out between AGI of $100,000 and $150,000. So 7-day rule, the IRS says that the $25,000 small landlord exception is not allowed when the average rental period for your property is 7 days or less. In the case your vacation home rental activity is considered a business rather than a rental real estate activity. That's kind of strange but true. So in the business scenario, your vacation home rental loss is deferred under the PAL rule unless you have a passive income from other sources or you materially participate in the business of renting the vacation home. So what constitutes material participation? It's a little confusing. We'll talk about that. So when you look at observation in some resort areas, the average rental period may be 7 days or less. The $25,000 exception to the PAL rule is unavailable if your vacation home falls into that category. Then you may have to pass one of the material participation tests explained, that we claim on a current deduction for your rental loss. So an exception for real estate professionals, another exception to the PAL rule allows qualified individuals to currently deduct rental real estate losses even though they have little or no passive income. To be eligible for this exception, you must spend more than 750 hours during the year delivering personal services in real estate activities in which you materially participate, and 2, those hours must be more than half the time you spend delivering personal services. In other words, working during the year, if you can clear those hurdles, you qualify as a real estate professional. Thank you very much. The second step is determining that you have one or more rental real estate properties in which you are materially participate. If you do, those properties are treated as non-passive and are therefore exempt from the PAL rules. That means you can generally deduct losses from those properties in the current year. Absolutely. So meeting the material participation standard, the 3 most likely ways to meet the material participation standard for vacation home rental activities are when you do substantially all the work related to the property. Number 2, you spend more than 100 hours dealing with the property and no other person spends more than you do. And number 3, you spend more than 500 hours dealing with the property. So in attempting to clear one of those hurdles, you can combine your time with your spouse's time. Realistically, however, if you use a property management firm to handle your property, you are very unlikely to pass any of the material participant tests. Always avoid a property management company if you can. Example 4, meeting the material participant standard. Say that you cannot take advantage of the $25,000 passive loss exemption for rental real estate because your AGI is too high, you have zero passive loss income, and you don't qualify as a real estate professional. So you're been piling up on suspended passive losses from your vacation home rental activities. It's not good. However, you may be able to transform the activity into a business by reducing the average rental period to 7 days or less. Then as long as you can pass one of those material participation tests for the property, you can completely avoid the PAL rules and deduct the losses against your other income. Yes. So that's good. Planning your vacation usage for the rest of the year. You may be able to micromanage the number of rental and personal use days between now and the end of the year. You know, your post-pandemic usage pattern may differ from the earlier norm. That usage pattern can potentially result in better or worse tax outcomes, especially when it flips your vacation home from personal residence to rental property status or vice versa. So for instance, you and your family may be anxious to spend more time at your vacation home and less time in the big city. That could put your vacation home firmly into personal residence category. So, you know, adding more personal use days may increase current itemized deductions for qualified residents, interest expenses, and property taxes. You know, however, if you're affected by the TCJA limitations on qualified resident interest expenses and property taxes, adding more personal use days may just result in bigger personal use allocations of interest expenses and property taxes that you can't currently write off as itemized deductions because the TCJA limitations. So the tax result will depend on your exact situation, you know, or the rental, let's say, demand for your vacation home may be so high that it's impossible to ignore the opportunity to collect more rental income. That could put your place firmly into the rental property category, you know, with some serious tax consequences. So in sum, the vacation home tax stuff can get complicated. Consider hiring a tax pro to advise you on how to get the best tax results for your specific situation. The main reason I got my real estate license was because I'm an investor and the passive loss. So, you know, absolutely, the passive loss write-off. As a real estate professional, you can have unlimited passive losses. So that was my main intention before I, you know, thought about focusing on real estate, and not specifically in California, buying and selling real estate outside of California and around the globe. But main thing was I always worked for Fortune 500 companies for almost 20 years, and I was fortunate enough to meet someone who was an investor in real estate inside the state of California, and outside I had a mentor in the Midwest, and they told me about the passive loss thing, but I didn't want to get into real estate full time at that time, and I always had a corporate job, and we were fixing and flipping properties at that time, and I learned what my broker was doing with the passive losses in the properties that he had. But he always worked in the corporate world, and he got his real estate license just for that purpose as well, like me. So we did it reverse. No intention of working in real estate and buying and selling real estate for clients. We were focused on our investments. So I'm still doing that to this day. Investing is my passion, but also helping people in their hopes and dreams for buying and selling property. So it's something you want to consider. You know, but knowing those tax rules on your second home is very important. You might be missing out, or you might be violating the rules. So if you don't want to take the time to learn this stuff, have a tax pro that can help you out. Take care. Be creative. Please.